Analysis of central bank accounts suggests that Japan has probably conducted its first currency intervention since 2022 to prop up the yen. For more, let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage. So Garfield, the evidence piling up that was intervention that we saw on the 29th, but the key question is, with the yen now 157.72, did it work? Was it worth it?
Well, at the very least, it pushed the yen back from 160. It got within 0.03 of matching the low back in 1990, and if it goes past that, then it'd be the lowest since about 1986. And there's not a lot of ready barriers to hang on to. So, from that point of view, it looks like something of a success, possibly a tactical success. And while you could argue that if the Fed somehow meets or exceeds the very hawkish expectations that it's facing, and also payrolls, depending on how they go, the yen could readily go back to those sort of levels. With the reverse argument would be, well, if they hadn't intervened and you were starting from 160 or more yen per dollar, then who knows where you could end up. 170 would come into play pretty rapidly, and that's the sort of thing that would have a lot of impacts on Japan's economy, on the political situation, and you can see too that we've had this inversion of the previous situation where it used to be a weak yen was welcomed by the Japanese stock market because that helped a lot of the exporters that are key players in the Japanese corporate sphere. A weak yen is no longer being seen as unalloyed good news for corporate Japan.
The yuan, of course, obviously is another dimension to this in terms of how long the yen stability might stay as well. Some interesting comments we got from the Politburo, maybe a little bit more expressed aggression in how they plan to support the still struggling property sector and the broader economy.
Yeah, I mean, it as ever under Xi, it's always a very measured push me, pull you setup. But they did sound more open to easing of various kinds, which probably makes it understandable. The news from this didn't come out until after we'd gone on a holiday, so there's no immediate pressure on the yuan. But it does seem as though it's going to make it harder and harder for the PBOC to significantly slow the yuan's decline in the face of a rampant US dollar. Now, if the US dollar pulls back, that's a different state of affairs. But on the one hand, Chinese equities in particular, we saw strong gains for property stocks leading into the meeting, and that those gains were validated to some extent because they definitely increased their interest in and work on how do we resolve the property situation. So for property stocks, for stocks in general, sounds like more support is coming. For the yuan, that dancing through the snowflakes task with PBOC, just got a few more snowflakes to dance through, and the main task would seem to be to make sure that the yuan's march lower is a smooth one rather than a disorderly one.
One of the potential variables you mentioned there was the possibility of a falling US dollar, though it looks pretty unlikely at the moment as we're on the eve of the Fed meeting. Markets seem braced for a pretty hawkish message here. What are we anticipating?
Well, a very strong anticipation that the Fed will signal that it's going to further delay rate cuts, and that indeed its initial guidance coming into this year, and then it was repeated in March, that it expects to cut 3 times this year, that looks extremely unlikely to occur. You would need to have by now not just a noticeable slowdown in inflation, but an actual deterioration in the way the economy is traveling, for them to look toward 3 rate cuts in the second half of this year. That's a pretty strong pace. And indeed, if you think Powell back in the beginning of this year was the base case seemed to be we cut in the middle of the year, probably June or July, on the way to these 3 cuts that we've penciled in. That looks very unrealistic now. So those are the sort of things you're going to want to look to. There is the potential that the bond market has overplayed its hand and that Powell will end up sounding far more measured than the bond market is expecting.
Garfield Reynolds, who leads our Markets Live Asia coverage there. Well, Harvard University economics professor Kenneth Rogoff says the Fed is unlikely to act on possible political pressure coming from the US government. He also told Bloomberg that he expects long-term rates to remain elevated for years to come.
It's not going to work very well. I mean, it's going to be obvious that it's not working. If you take away Fed independence, investors are going to get jittery, inflation expectations are going to go up, the dollar is going to tank. So happily, for better, for worse, maybe, I think markets will throw a pretty cold bucket of water on the president if he tries to do that. I don't think he would go to that extreme, but it's clear, he wants to be disruptor in chief, and it probably irritates him that Powell gets so much attention at his press conferences.
So markets there would apply the brakes in that scenario, which, of course, still being reported out, details unclear, so we won't go too far into the hypotheticals. But let's talk a little bit more about real interest rates. If we do enter into this environment where you have these episodic spikes of inflation, what would sustainably higher real interest rates mean for this economy when you think about the potential ripple effects?
Well, I think it really comes in the cost of borrowing for the government, for individuals. So remember, inflation's also driving up tax revenues. It's also driving up wages and salaries. But the real interest rates, they're there to stay. They're the wedge between the two. And this world, there's this period where you were just a sucker not to borrow as much as possible, whether it was to buy a larger house, whether it was to fund new government programs, et cetera. And I think, we live in a more normal world now. I'm not saying I'm telling you what interest rates are going to be for the next 20 years, but what I am saying is I think on average, they're going to be a lot higher than they were after the global financial crisis.
Ken, one last quick one, if I could. What does it do to growth if we have long-term interest rates?
Well, we've had long-term interest rates a lot higher for a long time and had better growth than we have now. It sort of depends on what's going on. I think to the extent it's driven by huge government borrowing, private borrowing, it's clearly a negative. You're just paying a risk premium to borrow. To the extent it's driven by AI and productivity and wondrous new technologies, then obviously high rates just go hat in hand. And maybe there's some of both.
That's Harvard University economics professor Kenneth Rogoff speaking there to Bloomberg's David Weston and Katie Garfield. Now, you can watch us live and you can see our past interviews on our interactive TV function, TV Go. There you can also